Hello, welcome to another episode of Firm Discussions. Today I'm joined by Tristan Wayne of Hurdle Rate, and we're going to talk about a company listed on the Australian Stock Exchange called Sequoia Financial Services. Is that right, Tristan?
Sequoia Financial Group.
Financial Group, there we go. Yeah, but before we get into that, Tristan, maybe you could just give us a bit of info on your background, your newsletter, and now your fund.
Yeah, so for those that don't know me, my name's Tristan Wayne. I'm an Australian and I'm 26 years old. So my background is in accounting and financial planning. So we'll go back to where I was straight after high school. I went into a degree of Bachelor of Commerce, just in like the Sydney area of New South Wales. And yeah, basically, I kind of did my first year, and what the degrees, what they allow you to do in my particular degree was do a general first year that everyone in the Bachelor of Commerce has to do before you pick a major. And I don't know if anyone that knows me, they would know that I'm pretty practical in nature. So really, my choice of major was it was off the back of what's going to give me the most employability. So accounting for me, that was like a natural first go. But then after doing some more research in accounting, financial planning was very, it synergizes very well with accounting. So a lot of accounting firms would partner with financial planners at the time. So I thought just having both of them as a double major, which is what I did, would be a really strong, I guess, CV for potential employment. And then yeah, from there, I started full-time employment the last 6 months of my degree, and then really at around the same time there was a banking royal commission. So a royal commission is basically government intervention into an industry. So they did a royal commission into the financial services industry because it was found that financial advisors were undereducated. They would give bad advice, and there was a lot of people really sort of a lot of really bad incentives and just people, not getting a fair go, getting ripped off, particularly with the pricing structure of like some of the products that they were being advised on. That whole saga pretty much turned me off financial planning. So I really went down the line of accounting. I saw financial planning as way too risky. I didn't even know whether my education was going to be, valid 12 months from then. So accounting for me was a no-brainer at the time, which I kind of regret
Just on that
hindsight.
point, Tristan. So what does the actual sort of regulatory process look like for becoming a financial planner? I know we have quite in the UK we have sort of qualifications you have to do and stuff like that. Do they have things like that in Australia?
Yeah, so I'll take a step back to before the Royal Commission. So before the Royal Commission, it was akin to being a mortgage broker. You really only had to do a few months at what we call it here is TAFE, but pretty much it's a third-party educational institute. It's not as advanced as a university degree, so you really had to do what's called a diploma. It's I think they list degrees on like a scale of 1 to 10, and a university degree, bachelor's degree, is like a 7. Diploma, it might be 1 or 2 below that. But it really, at the point of the matter is, you only needed a few months of education to become a financial advisor. So you had these people that quite clearly were not educated enough to be giving sound financial advice. So the Royal Commission, what came out of that was a very drastic increase in education and compliance standards. So now you need to do a full degree, which is, instead of 3 months, it might be more like 3 years. And you also need to do a few more stepping stones to get to like a non-provisional financial advisor. So really, it's gone from like a 3-month process to like a 6 or 7 year process. So barriers to entry are much higher than they used to be in the past.
Wow, yeah, that's I bet that must have been quite a blow for people that were working in the industry if they suddenly were told they needed to go back and learn all this extra or do these extra
Yeah, so
qualifications just to keep doing with their job.
this is all relevant to Sequoia, so we'll keep talking about it. But basically, the government in power at the moment, they're sort of grandfathering these rules. So for those with more than, I think, 10 years of professional experience, they are basically, they don't have to go back and get all of the education. So yeah, but especially for people that are new and coming into the industry, they have to do all of the new stuff. And then for those that are in the middle, a lot of those advisors were exiting the industry. So we've actually had, just prior to the Royal Commission, the advisor count was about 26,000, and now there's about 15,000 in Australia. So it's almost halved since in like the last 5 years.
Wow. Yeah. So you then, I presume you then you said you started employment, that would have been starting as an accountant then, and then you did that for a few years, is that right?
Yeah, that's right. I moved straight into a full-time accounting gig. And then at the same time, as soon as I graduated from university, I started a postgraduate degree, essentially. It's called CPA. So
Yeah.
it's different. It's different from country to country, but the CPA here is actually it's called Certified Practicing Accounting. But it's not the same as it's not like an international designation. Like it's they say they are, but really, if you take it anywhere overseas, you probably won't be getting taken seriously. Yeah, so basically that was a 3-year thing, but instead of it being like a 3-year full-time university degree, it's a 3-year, you work full-time while you do this. So I like to say I've done 6 or 7 years of study, but really it was like 3 or 4 years of full-time, and then another 3 years of I'm working full-time and I'm studying.
And then, so is there, I'm guessing that tailors the accounting knowledge to the accounting standards used in Australia. Are they particularly different from something like IFRS or GAAP?
So Australia, the accounting standards here are they're set by the Australian Accounting Standards Board, but they're actually adopted from IFRS. So most of our standards are basically copy and paste IFRS standards.
Pretty transferable then, yeah.
Yeah, exactly. So it would be very in line with what the UK might look like. But where it differs, obviously, is taxation. Taxation differs a lot more than accounting standards. Yeah.
And I suppose that's a pretty big part of the role of an accountant day to day anyway, dealing with tax.
Yeah, well, I suppose it really depends on what area of accounting you're in. So it's not just simple as being I'm an accountant. It's like you can go into
of course,
various different areas. So you can go into auditing, you can go into management accounting, you can go into corporate advisory, you can go into all these different areas. In particular, I was a small and medium business tax accountant. So that's where I've been working the last probably 5 or 6 years now.
Yeah, I guess that's an area that has a lot of work, isn't it, with the number of companies in that segment?
Yeah, there's something like 3 million businesses listed in Australia, and
Wow.
you could probably say more than 90% of those are small and medium in classification.
Yeah, I imagine that. I wonder how many of those are actually trading as well. That's got to be. I mean, how many
Yeah,
people live in Australia?
there's many businesses. 26 million.
There you
It's like
go.
more than 10%. But yeah, a lot of those, a lot of people, as they set up multiple entities, especially for the high net worth,
Yeah,
they'll have quite complex structures.
of course. Yeah.
Um, if you want to get into, we can get into, but basically, yeah, you can kind of say there's client groups and then there's clients. So a client might have multiple different entities under a group.
Hmm.
Yeah.
Yeah. So then you did actually you have your own newsletter as well. So maybe you could sort of let us know about when that started, at what point along this sort of journey, what prompted you to start that, and what you do with your newsletter.
Yeah. So I started investing, I guess, unofficially in high school when I was 14. I got my first part-time job. And I'll breeze over that. But basically, I was sending money to my dad to invest on my behalf. And then I took ownership of that money. So basically, I sold his shares. That was actually my money. And then started investing in my own account in 2017. And then that really was not a structured process until mid 2019 when I actually started writing.
Hmm.
And then I did that under various different pseudonyms. Like sometimes it would just be my direct name. Sometimes it would just I had a few different pseudonyms. So I actually had one called Aussie Contrarian back in the day, where I would write articles, blog posts on companies, and then I moved to Professional Value, and then just earlier this year I changed that name into How to Rate.
I remember following you when it was professional value. Yeah, so I've seen that part of the
Mm.
transition.
Yeah, yeah, and then I suppose so. Over that span of 3 years and 2 months, I wrote 130 different blog posts. So quite a bit of research. Um, and then in May of this year, I actually sort of decided to start a unit trust. So in Australia, um, you have to be a licensed financial advisor in the vast majority of scenarios. But I actually started a unit trust to take advantage of um, these small scale offering rules, which is
Hmm.
effectively allows you to raise very small amounts of money from a very limited amount of people. Um, so yeah, I started that for friends and family. So you're not allowed to market it either. So um, I'm not going out there and asking, "Do you want to invest my fund?"
All right. Yeah.
Yeah, so I'm pretty careful about that. But yeah, basically that's started officially in May, and now we're going into our fourth month next month.
Yeah, that's great. And you do actually you do publish the stuff from your unit trust as well, don't you? You're updating things monthly, is that right?
Yeah, so every all of the administration and letter writing and minting and cancelling of units is done on a monthly basis. So I try to align everything at month end. Um,
Hmm.
that just makes everything easier for me. It's kind of ingrained in me because we used to do it in accounting as well. But yeah, everything would be done in the month end. I would mint new units and I'd put out a letter. I've actually compiled all of those letters and also constructed, sort of distilled a lot of my investments into one page thesis, if you want to call it like that. Um, yeah, so you can find that as a pinned tweet on my Twitter profile if you're interested.
Yeah, it's a good resource, especially if you're interested in the companies in your portfolio as well. Because you, like you say, you've got the one page sort of summaries, and then you've got updates and so on as well.
Yeah,
go
and
go along?
I suppose I should probably say how I invest as well. But basically, I've started leveraging my experience as an accountant, and more minimal experience in financial services. But yeah, we're looking to just basically invest globally, across the accounting and financial services service lines, if you want to call it like that. And that also includes, maybe suppliers that might supply these firms, and then more fringe uh, professional services firms that I'd probably in a good place to understand, like legal firms and potentially
Mm.
even engineering firms or architecture. But
And I was quite
I
surprised
tend to
actually.
tend to stick to accounting.
Yeah, I was quite
What was that? Sorry.
surprised when I was quite surprised when I started. I remember following you when you were professional value and thinking there can't be that many firms, and I surprised by the the number of firms you came out with all these different names I'd never heard of and things like that. It's a very
Mm,
there are a lot of smaller, sort of medium sized, publicly listed companies that fit within that sector, aren't there? So you do have a pretty big playing field to explore, especially when you're looking globally.
yeah, I mean, you'd be surprised. Well, actually, I mean, in the grand scheme of things, my watch list is not that big. It's a little over 200. It's actually, you'd be surprised that the vast majority of those are actually Australia and UK. So
Hmm.
probably half of it is just accounted for from those two countries alone. So it's surprisingly there's not that much in the US, despite its overwhelming majority of the global economy. And in China's a different story though. So
Yeah.
I tend to avoid um, investments in China.
What about sort of other European countries? Is there sort of a language barrier or something that puts you off a bit there, or just you
No,
haven't started
definitely
to
not.
explore them yet?
Yeah, definitely not. I've written about a lot of those. It's yeah, Google Translate's your best friend. So um, it's not perfect, and I do have a little bit of hesitation around making like large investments in smaller emerging markets, that I might not quite get the because obviously it's not my primary language. I might not get the ability to read between the lines of what people are saying. So I tend not to. I suppose I don't think it's prudent to really make large investments in.
And you're quite
Yeah,
you're quite concentrated as well from the look of your portfolio. So I guess each investment would be relatively large on a percentage
yeah.
basis. Yeah.
Well, I've always been concentrated.
Hmm.
I've tried to become more diversified at times, but it just does not mesh well with my I guess my personality. I don't really understand. Like I'm more akin to making bad decisions when I know things less.
Hmm.
So
Yeah, that
if
makes
I've got
sense.
less
Yeah.
stocks in my if I got less stocks in my portfolio, I know more about each one.
Yeah,
Kind
I
of my
completely
rationale
agree
for it.
there. Yeah,
Yeah,
I'm of the same mind. Definitely
yeah,
want
and I mean,
prefer to like I feel there's less risk in my mind if I understand everything that I own to the highest degree
yeah.
possible.
Well, what I don't know, I don't know who to attribute this quote to, but basically, it's a diversification quote where you can either have all your eggs in one basket, or you can have all your eggs. Oh, sorry, you can have all your eggs in one basket and watch that basket closely, or you can diversify. So
Yeah,
yeah,
yeah, I kind of
yeah.
get the the gist of it. Um, yeah. So yeah, I mean, the other thing with your newsletter, I've always, as a newsletter writer myself, I've always been impressed with the the amount that you managed to put out. It's considerably more than I can put out. But I guess so you are doing you've sort of changed your model over time, haven't you? You used to do or was it I don't know exactly, but I remember there was a time where it was more longer ones, and then you started throwing in the sort of one page uh quick ones that were then going out on, was it a weekly basis or something like that? And then you've had a few different variations of the model. So what have you now settled into, would you say, on that?
Yeah, so this one, it's not an easy one to answer because it's really sort of varied. Some, I've come to realize that some investments really don't need much to really convey the main thesis. So yeah, there was a period of time at the start where I would write very, very extensive write-ups. So I found that it was great for understanding business, but sort of 80-20 eventually took its toll on me. And I could turn over a lot more rocks if I was sort of getting to the point quicker. Um,
Mm.
so through the period of 2019 to 2021, that was really before professional and value and hurdle rate. Um, I was doing predominantly more long form pitches. Eventually, over time, those sort of reduced in length, and I kind of landed on 5 to 10 pages. I was actually putting out like PDF documents. For those of you that might have been following me for a while, I used to put out these PDF documents of sort of 5 to 10 pages. It would sort of distill the thesis that way. And then at the start of 2023, I decided to start doing like 1 page pitches. And that was like an exercise in sort of comparing my ability to pitch things quickly, as opposed to a deeper dive, which honestly, um, smaller pitches tend to work better. I think there another quote, don't know who to attribute this one to, but the thickness of the research file, it runs inverse to the portfolio returns. So, if you can get to the point quicker, try to avoid any sort of commitment bias. Yeah, definitely.
Yeah, no,
That's the way to go.
yeah, I know people always talk about it's quite a few people. I think Joel Greenblatt was one person who might have said something along those lines, talking about
Mm.
the ideal pitch can just be done in 1 page or something like that. But yeah, mine tend to be quite long, but that's mainly because I'm putting it's kind of my due diligence on it's companies I own normally, and it's the due diligence I'm doing on the company. So I'm going through and just all of the little details and stuff like that I think I need to understand to
Yeah,
really,
I've
and
read some of your tiny build posts.
I kind of put a lot
Definitely
out
lots of
there.
detail. Yeah,
Yeah, it's not, you don't need all of that to do the pitch. You can do the pitch in a Twitter thread or something. It could be really concise, but it's to really get to the stage. I'm kind of trying to put out a level that you need to get to really feel comfortable in buying the company almost. You'd have to still
yep,
go beyond that and look at the funds yourself, but it kind of it goes through all the detail I have to go through before I'm comfortable with buying anyway, which can end up being
yeah.
like
Well,
10,000
I
words or
mean,
something.
even though I've written all these posts, the actual research behind it is significantly greater. So,
Mm,
distilling something into a single page, if you were to write down every little thing that you looked at and your initial thoughts on those things, you'd probably get closer to over 100 pages. Um,
yeah, yeah,
so, yeah.
absolutely, yeah. Yeah, and for myself as well, I've kind of shifted a bit to doing a kind of a weekly updates model. So it's just like
Mhm.
little quick things that just go out each week on the company. So it condenses uh that ongoing research into like a series of things rather than, you know, trying to
Mm,
do it all in one massive post at the end or something.
makes sense.
But anyway, yeah, should we move on to having a look at talking about Sequoia for a bit then?
Yep, absolutely.
Yeah, so maybe you can just start by giving us an overview of the company, the products and services they offer, that kind of thing.
Yeah, I just before I get into Sequoia, I just want to preface it with this: not financial advice,
Of
not a
course, yeah.
financial holder, financial advisor. I do hold shares in the company. Um, so I guess I will start with the uh, the details of the stock. So it's a $75 million company. I think actually $73 million as of today.
Is that
It
is that
trades
US dollars or Australian?
Australian dollars.
Australian dollars.
And it trades on average sort of 20 to 30,000 Australian dollars a day, so quite a liquid. The company's been listed on the ASX since 2000, but Sequoia was not actually acquired until 2015. So we have a pretty common theme of what's called reverse takeovers here in Australia, where the listed company would be approached by a private company, and what would effectively go on is that the listed company would raise funds to acquire the private business. It's called a reverse takeover, or a
does the management of the private company then retain control of the combined entity afterwards? That's why it's the reverse takeover. Okay, yeah.
Yeah. So the listed company, it has the directorship, but it's really, most of the time it's either dormant, or the activities are just so unprofitable that they need out. So yeah, typically the private business management comes on and takes over the board. So yeah, moving on, it's a financial services business. It's really quite diversified. Only operates in Australia. Its main clientele are accountants and financial advisors. They define their business into 4 key service lines. So licensee services, professional services, direct division, and equity markets. So if we go into each one of those, licensee services, as we talked about earlier, it's related to financial advice. So to provide financial advice, you actually need a financial services license, and or be appointed as a representative of someone that does hold a license. So what they do is they actually have, as of today, 2 financial services licenses, where they act as the licensee, where advisors can be appointed. So advisors would act on Sequoia's behalf as a representative.
Is there some sort of reputational risk there then, if the regulators, or is there some complaints against some of the clients that they've given a license to, comes back? Is there like a chance that they could lose their license under these circumstances then?
Yeah, so you touched on that point. That's probably something to talk about a bit later. But these firms that are appointed by Sequoia's license. So Sequoia owns 2 licenses. It's one of them is called Interprac, and then the other one's called Sequoia Wealth Management. And then they used to have one, but there's basically no advisors under it right now. It's called Libertas. It's one they acquired a few years ago. So basically, these advisors that would come to be appointed, they run their own firms. So that's their brand, not the license. So you're not going to Interprac to get financial advice. You're going to the owner of the firm, and the firm just so happens to license through Interprac. And Interprac, they also have a securities arm where they hire advisors directly. There's not many advisors that are salaried, and their family office, which is like private wealth division, which also has a few salaried advisors. So those are direct, like hired advisors that are under the AFSL entity, not like representatives. And the licensee division also has a corporate advisory business, so like raising equity, an insurance broking division, which is predominantly around sort of accountants insurance, so professional indemnity insurance, and then smaller, but I guess still part of that division, they have a premium funding business, which basically breaks down insurance premiums into like installments, and it charges a fee for that. Pardon me. So that's the licensee division. And that division really is very, very small margins. And that's because the licensee actually receives revenue from the clients and then pays like a revenue share to the advisors. So what you're really getting there is like an underlying profitable. So like gross profit would really be your licensee revenue, but because it comes directly to them, they have to, it sort of shows up on the accounts.
So it's almost like a royalty in a way.
Yeah, exactly. So that's the licensee division. Professional services division includes, there's several acquired legal document providers. So what these are basically like company establishments, so trust deeds, constitutions, any sort of ASIC related. So ASIC being the regulator for financial advisors and companies here in Australia. So any sort of ASIC documents on any movements in share equity, or just various different things, director changes, whatnot. They pretty much provide all of these documents for a fee. So they've got 3 legal documents businesses under that division, and then there's also a superannuation administration division. That's a long word, but superannuation is basically our pension system here in Australia. And this division, administration, is actually for self-managed funds. So you have the choice of going to, we'll call them larger superannuation funds, or you can make your own. So this division basically does all the accounting for those people that make their own funds. Okay. I don't know how to explain it more simply than that, but
sounds a bit like a self-invested personal pension or something in the UK.
Yeah, well, effectively, it's like making your own company or making a trust. Oh,
okay.
It is a trust in itself, but
so the individual people who are saving their pension are effectively making their own fund structure, rather than it being just they're having direction about the investments they're making and so on.
Yeah, it's really hard to explain, because there is actually larger funds which are so one's regulated under our tax office, and then the other is regulated under the banking regulator. So it's called APRA, Prudential Regulation Authority. But the SMSFs are regulated under the tax office, but effectively you can appoint yourself to either or an APRA fund or the ATO fund, the ATO fund being the self-managed fund. But you have to do all of your own compliance. So this administration, they basically take care of it for you. That you have to prepare financial accounts, you have to mark your investments to market, you have to do an investment strategy, you have to it gets particularly complex when you start getting into well, we have 3 stages for super. We have sorry, I'll break it into 2 stages, because there's a middle stage. It's not really relevant here, but there's an accumulation phase. So employers make compulsory contributions up until you basically retire, and then when you retire, it's got you'd start taking a pension out of this fund. So it gets particularly complex when you get into pension phase, because there's all these different things that you have to do, and when you have 2 different phases running at once, that also gets kind of complex as well. But yeah, effectively, SMSF administration is accounting for these funds, and then there's also a finance broking arm. So I think I can't remember exactly what type of broking they do, but I think it's predominantly insurance broking. So these, like I said before, oh, actually, did I? I already talked about that, didn't I? In the licensee division, I might have misclassified them, but I think they have some mortgage brokers as well underneath the business.
Okay.
So that's 2 divisions down, 2 to go. Direct division has their asset management business. So this business provides general advice to high net worth investors, or also called sophisticated or wholesale investors. So the general advice being pretty, I guess rudimentary. It really sort of is I guess you'd say, a way to curb people into their other services, I suppose. They have a research business, so there's 2 different. There's something called, they have this website called the Yield Report, which pretty much reports on the Australian yield curve every day, and updates that every day. And then they've got this other one called Corporate Connect. I actually haven't looked at Corporate Connect before, but yeah, those 2 businesses are a really small part of what Sequoia does. And then more recently, they acquired in March of last year a pretty large media business, which allows companies to effectively advertise their stock. I don't like it. I don't like the ability to advertise, and pretty much also like retail investors. So
Okay.
You would call it spruiking. So that business, effectively, they charge advertisement fees for these companies. And then the equity markets division, probably less relevant given what's happened with Morrison Securities recently. So Morrison Securities it's an ASX clearing service. It effectively is like a level above the broker. So what the ASX, they have this bidding process where you get into the market and you have to find the reason it's so simple on a brokerage account is because they do the clearing for you. And Morrison's is effectively this part of the value chain.
Market maker is another term.
Market maker.
Yeah.
So it's not they have a broker. It's really an institutional broker, and then market maker as well. So they do the clearing for like high net worth, and especially in derivatives, like really well, like really good reputation in derivatives trading in particular. So that being like options and warrants and whatnot. But the other part of the equity markets division is called specialist investments. So this is relatively complex as well, but they basically offer what's these like investment opportunities, but they're structured particularly to target self-managed super funds. Because self-managed super funds, they're not allowed to go to the bank and get their own loan, so they can't do margin investing. So these products they're structured as agreements where there's like an installment factor. Deferred purchase agreements is what they're called. But basically, you have to pay the interest and the fees up front, and they give you like leveraged exposure to the underlying investment. So, yeah.
Cool. Yeah.
That's all of it.
That's a good thorough overview. I mean, something that you kind of touched on a bit there was the various sort of companies they'd acquired. So it does seem to be a significant component of the business's operations over the last few years has been M&A activity. So, I mean, do you want to discuss maybe some of those deals in specific deals, maybe, and then the sort of performance you've seen on those evaluations, and how has there been any sort of integration issues with integrating those businesses, which some of them, even though they're financial services, they do seem to be quite different, the different segments, how they've been integrated into the wider business.
Yeah, so I don't know what it is with financial services business in Australia particularly, but they really think there's a really strong need to consolidate. They all think they have like low margins because, you know, they're not the biggest. But from my point of view, the licensee division is predominantly revenue share model, so mostly variable. But nonetheless, they think that scale is required, and that's no exception with Sequoia. But so we'll start with the major ones. Obviously, in 2015, there was the reverse takeover of Sequoia Financial Group. So at the time, Sequoia Financial Group was just the really, it was the Sequoia asset management business, and parts of the equity market division. It didn't have any sort of advisors under it. It wasn't until they acquired Interprac in 2017 that they sort of brought in a lot more financial advice. And I mean, Interprac was acquired in 2017 for about $12 million. And then Gary Kroll, who is the current CEO of Sequoia Financial Group, he was the co-founder of Interprac in 2003. So Sequoia reverse listed in 2015. The founder of Sequoia was Scott Beaton. And then he made the decision to acquire Interprac in 2017, brought on Gary. Gary got onto the board in 2018. So at the time they acquired Interprac, it was, you know, they paid 12 million, and it was doing profits before tax of 2 million. So, you know, on face value that looks okay, but I think they issued some shares to do that. So there's a bit of dilutionary component to that. But since Gary took the position of CEO in 2019, so Scott actually stood down, and he is no longer with the business. But what's really relevant, I guess, is suppose from any acquisition from 2019 onwards. So I've observed that since Gary was appointed in 2019, he's done 11 different acquisitions, and I've kind of combined the smaller stuff where he would just like acquire a couple of advisors. So I've kind of lumped all those into one. But over that time, he's paid an average of 4 times EBIT, which is pretty good. But an after-tax multiple of about 6 times earnings. So despite this, the business has remained net cash the whole time, but they have not been like the same level of restriction with the share count. The share count's diluted by about 7% per annum. So they acquired for 6 times earnings. That's about 16% earnings yield, but then they diluted by 7%. So per share acquisitions, I think it's about 9% per annum in the past 4 years. And they've paid out roughly 20% of profits on average over that time. So, you know, do the math on that. So return on capital, 11%. So not particularly great, not terrible, but, you know, more positively, the group's strength is really in sort of post-integration and organic growth. So over the time period 2019 to 2022, the group's grown their profits by on a total basis, it's about 30% per annum. But if you include the dilution, it's like 23 or so. And of that, 9% was inorganic. So 14% is just like for like revenue growth and earnings growth. So really, their history of acquisitions is okay. I think I'd prefer just to pay larger dividends, but I'd focus more on organic growth. But it is what it is. Regarding integration, do you have any questions on that before I move into this?
No, I think that was good. Yeah, I think you kind of touched a little bit on integration there. It does sound like they've been relatively successful if they've managed to generate organic growth. Is that sort of coming from any particular companies in or subsidiaries? or is that like across the board that growth has come?
I haven't gone to this sort of level of detail, but from generally speaking, it's across the board. Like it's all pretty well growing. I suppose a lot of the revenue growth is it's hard to say as well because the margin profiles are so different. Even if one company can grow so much revenue, it might be dilutionary to margins. So, but generally speaking, it's like pretty even across the board. So
I suppose if once they've acquired the companies, they'll report via division, won't they, rather than by specific subsidiaries.
Yeah, exactly. So you can't say, okay, they acquired SEQ.AX in 2017, but they actually don't report SEQ.AX results. They just put it in the licensee division. So
right, okay.
I don't know how much of that is SEQ.AX. But nevertheless, integration, there is one particular just recently that so they made the acquisition of what's called the Informed Investor Group in March last year. They paid $3 million up front, and there was a 1-year earnout of 3.1 million shares. And they didn't actually hit the performance hurdles, at least not from the Sequoia point of view. And the vendor, his name's Tim McGowan. He's the founder of that. Well, the business is called Share Cafe. He's the founder of that business. He was appointed as the head of the direct division when they acquired that company. And then when the deferred payment came due, there was a difference in opinion. And Sequoia actually fired him for misconduct. So there's been some legal dispute around that in the last few months. There's a few other members that were supposed to get shares as well. So that 3.1 is not just to Tim, but basically, yeah, there's a lot of issues around that particular acquisition. But
well, at least it saved the Sequoia shareholders from if that had been all paid up front. It does show you the value of contingent consideration, doesn't it?
Yeah, and the issues. So yeah, if you have some, presumably the misconduct relates to fudging revenue figures or something. I don't know, but they never actually say what it was for. Maybe it'll come out in the wash eventually. But yeah, they've been paying legal costs associated with that. So presumably some of that is some of what they've said in the most recent releases. There's a lot of normalization.
Was there some like write down of, I guess they on the balance sheet it was recognized as goodwill then, the sort of against the contingent consideration and so on. So did they just write that down when they?
Yeah, they write that back.
Yeah.
So if writing back that is actually a profit. So
yeah, but it cancels out with the contingent consideration and so on. Yeah. Well, if they had an asset, because they often will have like an asset recognized on the balance sheet that they've acquired in goodwill or whatever, and they'll write that down, and it will compensate for the contingent liability going down as well.
Yeah, it nets out. But yeah, so that's the main observable problem with integration. It sort of trumps any other problems of integration. But yeah, there has been sort of Tim went to the media with this particular issue, and we have a financial review, like news source here in Australia, and there was a multitude of posts around his. So he was basically like sort of like a whistleblower. He sort of went to the media. He's like, "Oh yeah, I got fired. Can you talk about it? Can you do a post on it?" And there's no substance to it really, but yeah, he sort of mentioned in those news posts that there was more than one vendor in the past that had issues with what Sequoia was doing, but I feel like that it's par for the course with an acquisition model.
Did you see any sort of around the time this news was coming out and all this controversy? Was there a noticeable impact on the share price?
No, not surprisingly not particularly noticeable, but yeah, well, very minor, but I think nothing more than what the share price usually does because it's so liquid. Yeah, but it is what it is. I don't think there's any particular good examples of post-integration issues that are any larger than what that one's been, because that was one of the largest deals done as well. So I think, yeah. So I guess we'll move on to the divestment.
Yeah, the Morrison's divestment. Yeah. So what was the motivation for that sale?
So they have had the view that the Morrison business had substantial value. That was like on a sum of the parts basis being valued substantially less than what they can get in the private sale. And that's because of peer transactions that have occurred in the past. So they acquired that business around the same time as Interpract in 2017. And Scott Beaton actually acquired it, so it wasn't Carey. He acquired it for $3.6 million. And they just announced this year that they're selling 80% of that business for $40.5 million.
Wow.
On a 100% basis, that's over $50 million of like valuation. So it's, if you do the math, it's a 15 bagger in 5 years.
Wow.
So pretty good for Sequoia. That business, I explained a little bit before, but it's a white label trading solution. So actually to AFSL holders, so they can actually put their own branding on it and do all their own trading on it. So it's marketed to financial planners, banks, and traders. And it was actually established in 1985, so it's like a really old business now. In March, the group announced it entered into an agreement to sell 80% of the business, and the vendor's name was New Quantum. And this is really where sort of all of the uncertainty lies. New Quantum, they tried to acquire a similar business called Open Markets last year, and it actually failed because they didn't have funding. So the market, presumably, they're viewing the deal as unlikely to finish because of New Quantum's, there's questions around New Quantum's ability to fund the deal. But they actually just probably 2 or 3 months ago now, they actually there was a SPAC in the US that acquired New Quantum, and the SPAC raised $1.1 billion to buy New Quantum. And New Quantum, it's nowhere near worth that much, but they bought it. So it's actually got the SPAC backing now. So I think it's quite likely that the last payment comes through. And speaking of the payments, because of the funding risk, Sequoia, they structured the deal into like a 4-stage installment. So there was $1.5 million deposit. So wait, I'll step back. The deal was announced on the 9th of March. They paid $1.5 million as a deposit. And then there was another $9 million due on the 20th of March, another 15 on the 31st of May, and then another 15 on the 31st of August. And then along with that, they threw in a call option. It's in the event of the failure to make tranche payments, it would allow Sequoia to repurchase at a discount to what had been paid today. So it would allow them to retain full ownership, but also make a profit out of the whole process. So those call options would make a profit on the 3rd and 4th tranches. So if the 3rd tranche failed, Sequoia would have had $10 million in the trust, but they'd only have to give back 7. So it's $3 million in profit. And then the 4th tranche, they'd have $25.5 million in trust, but they only have to give back 17.8. So it's $7.6 million profit. So the final tranche is actually due tomorrow. If they fail to make the payment, shareholders profit 7.6 million, and it's pretty substantial when you think about it, because last year they actually did less than that in profit for the full year. So that's the Morrison deal.
And would you say, just like on, you said talking about peer valuations, is that sort of is the company acquiring it going to feel like they're overpaying there? You know, that, I mean, now this SPAC is potentially taken over, are they going to feel like, oh shit, we're getting a bad deal here, and they want to cancel it? Or is it a fairly reasonable price compared to markets? Or is it also the case that perhaps the valuation was done when markets were hot and they've now cooled a little? Or
well, it's too far gone now. So they've actually done the share sale agreement. So they actually have control of the company now. So it's too far gone. If they fail this last payment, Sequoia can buy the business back and get that profit that I said. But
there's literally no point in them doing that at all then.
There is really no point, because they just copped this $7.6 million loss. They have to buy it. They have to commit. They can't not do this. It would just be such a failure for them.
Yeah, that makes sense. Yeah. So yeah, you mentioned about the profits there. So I understand. Yeah, we're expecting to see the latest set of results coming out tomorrow. Is that right? But you were telling me beforehand that we're expecting profits to have fallen compared to the prior year. So maybe you could sort of discuss that a little bit.
The company earlier this month, they put out a trading update, like a sort of pre-announcement for the full year results, just highlighting what they expect. So they sort of expect, they mainly report on like an EBITDA basis, and they expect a full year EBITDA to be between, to be 5.5 million, but that is inclusive of what they call normalization expenses, so like non-recurring expenses, the usual. And they expect normalized EBITDA to be 9 million. Last year it was 12.4, and there was no normalizations. So any way you look at it, that's pretty significant decline. And that is including Morrison's. So it's pre-divestment. That won't actually be like enacted until next year, or next financial year. So it's really this financial year. But anyway, but basically there's two parts to this result. There's the factors in their control and the factors out of their control. So the factors, I suppose you could say this one is either in or out of their control, and it's the trading volume of Morrison's is down like quite significantly year on year. I think they quoted in the first half result that it was down 30% year on year, and they make brokerage fees on every transaction. So pretty clearly that one's going to be quite impactful. And Morrison's, that accounted for about say 15% of the profit of the prior year. So 30% of that, it's reasonable. You could say that's about between 3 and 5%. And then there's also there's a number of different lines that they quote here. It said company establishments have also fallen by a quarter year on year. There was less advertisement activity in their media business, presumably due to rising costs because of inflation. There's less IPOs during the year, so their corporate advisory business has fallen. They took the decision to advertise less wholesale investments as well. That was a conscious decision by management. The rationale being that they sort of thought that the offerings, if they made those offerings, that their clients might experience losses. You can kind of make the call whether that was good or not. In hindsight, it looks like a great decision, because markets are not particularly well performing in the current financial year, but they also had, and you made this point earlier, they raised the provision for an advice claim. There was a client that received advice in 2019 from an advisor, which is no longer in the group, and they claimed $2 million. So what they've done is they haven't paid that amount, but they have
That's a pretty big
raised
chunk.
yeah, they've raised the provision. So provision is an expense. Yeah, and they're sort of chasing the recovery of that amount with the insurer that they had at the time. So that's an ongoing process. In the second half of the year as well, and they don't say this, but I sort of went to the ASIC website and had found that Morrison's had paid a $330,000 fine to ASIC for some inadequate internal controls a few years ago. So relatively common for market dealers, I think. But yeah, that's the results. I'm not particularly concerned. I think there's been a lot of issues with the macro economy, and then also at fault of their own, the legal issues as well, which are which you'd expect to be non-recurring. Like, you're not going to have a person come and claim $2 million every year, because it was related to an advisor that they've since gotten rid of. Yeah.
So we're kind of as you see it, we're kind of in a bit of a cyclical trough at the moment then, with the earnings just from all these various, I mean, some of it is individual, it's specific to the company, like the legal stuff or whatever, but the wider macro stuff is largely cyclical. Is that what you're saying?
Yeah. Well, I think it's hard to say what IPOs will do, but yeah, it's really hard to say organically what the development will be in the future. But I'm kind of like normalizing it at give or take $12 million of earnings, like EBITDA. So they're going to report 5.5 on a statutory basis and 9 with the add backs. So to some degree, I do expect a bit of recovery, but there's also some acquired earnings which have yet to roll through. So with the issues of the media business, that business is probably unprofitable for the year. So there's got to be some more integration with that business to be done. But there's also a few acquisitions that they made in June and July of this year. So they made an investment into like an asset management business. It's a pretty small investment. It's about $1 million. And then they made $3 million into a legal documents business in South Australia. So, Victoria.
Okay. Yeah, and I mean, what kind of I think, yeah, with the Morrison divestment, what kind of an impact is that going to have on their earnings going forward? How much was that contributing?
Yeah, so Morrison's doing about $1.5 to $2 million of EBITDA. So on their 2022 results, that's only about 1.6. And then the price before the deal, the market cap was about $65 million. And they're getting $40 million in cash. So it's 2/3 of the market cap. We'll say 60%. So it was only generating about 15 to 20% of the group's earnings.
It does beg the question of the where the acquirer saw the value if they're getting something that's got $2 million, $1.5 to $2 million EBITDA, and they're paying.
I don't know.
40.
Doesn't bother to me. Like, no. Too far gone. Too far gone. We've already got our money now. They can deal with the problem, but we still do have a 20% shareholding in that business. So, I don't want it to fail completely because it's still a bit of the business. Yeah.
Sequoia stands to benefit if they do manage to realize some growth vision from it.
Yeah, well, I mean, Gary actually said in a media interview that he's a sort of his true north, or he's like, he really wants that business to pretty much be the same size as they sold it for. but only 20% of the shareholding. So he basically wants it at 5x. Like that would make him as happy. That would make him, pretty happy, I guess. But that's what he said.
Yeah. Yeah. So maybe moving on to management. Could you maybe give us you've mentioned a few names along the way, but maybe you can sort of give a bit more depth on who these managers are that are running the company, what kind of ownership stakes they have, and their compensation, performance, all that kind of stuff.
Yeah. So as discussed, Gary Kroll is the CEO. He took over from Scott Beaton, who was the founder of the Sequoia business before the reverse takeover. So he was the founder of the private business that got bought out in 2015. And then he went on to be the CEO for another three years.
Am I right in saying you interviewed him at one point as well?
Gary, yes,
Yeah.
but I didn't record it. I just took the notes. But yeah, I've spoken to him a few times. Gary owns 12 million shares. There's 137 million on issue. So that's about 8% of the company. He's the founder of Interprac. So he was brought in 2017 when Interprac was purchased. Prior to that, he actually founded a company called Money Planners in 1988. So he's getting up there in age now. I think he's about early 60s, or maybe late 50s, somewhere around that age. And that was acquired by a business called Deakin Financial Services in 1990, and that's actually an ASX listed company, or what it used to be. And he became the CEO of Deakin and ran the ASX listed company for 10 years before he resigned and founded Interprac in 2003. And Deakin went on to be acquired in 2004, and then again in 2013. So like under two different names, but same business really. Other directors, including Gary, they hold 11% of the company. But where this gets bigger is a lot of the subsidiary heads also hold shares in the company, particularly the head of the professional services group. His name's Brent Jones. He owns another 8%. So,
Wow.
I don't have all of the details on what shares employees and subsidiary heads have, but it's at least 20%. So at least 20% insider ownership, really.
How did that you said that division head, was that as a result of an acquisition then? He ended up with a fairly big stake or something.
So Brent Jones, from what I understand, he is a co-founder of Interprac as well.
Okay.
Just fact check myself there. I'm pretty sure he was. Yeah, that's right.
So yeah, he got his stake from when they were acquired. Yeah.
Mm-hmm.
Makes sense.
Yeah, I suppose compensation. I don't have the figures in front of me, but I don't think I've had a problem with it in particular. I think the shareholding is big enough for them to be more aligned with shareholders without any sort of incentive plans.
So it's just the standard kind of bonuses and what have you.
Yeah, I can't remember off the top of my head, but I didn't think I had a particular problem with it. We'll go with standard.
Okay. Yeah. So obviously they've now got these proceeds from, or soon will have fully the proceeds from this divestment. What do you think they're going to do with this? Have they given any kind of guidance? It's obviously quite a substantial amount of capital they now have to deploy. What is it? What are their plans that they've outlined? And what do you think would be the best use of that money as well?
Yeah, I can definitely talk to that. So before last year, they amended this last year, but they've had it for 2 years now. They have this strategic plan, which initially it was for the period 2021 to 2027, or maybe it's 2020 to 2027. And they wanted to grow initially they wanted to grow their revenue and earnings to 40 million and 30 million by 2027. So 400 million and 30 million. And then they amended that last year, and they basically, with the rationale that we're doing it less via acquisition, so they wanted to do it slower, but more organic. And they amended it to 300 million and 30 million by 2026. And then for reference, the group just guided to financial year 2023 revenue and EBITDA of 130 million and 9 million. So they need to 3.3x the bottom line and 2.5x the top line in 3 years. So it's going to be pretty hard for them, but they have a lot of cash to do some acquisitions, so that should help. So they've signaled intent to actually grow the margins a lot. That was talked about in the first half earnings presentation, or no, actually the May presentation, which you can find on their announcements list. And they have also signaled intent to move to a payout ratio closer to 100%. So as per the plan, it was supposed to go like progressively 10% incrementally up every year. So 40%, 50%, 60%, 70%, and then peak at 70%. But Gary, after the deal, they haven't explicitly said this, but he said they want to be closer to 100% come the next financial year.
I suppose they have a lot more cash to do the acquisitions they need to do. So yeah, all the incremental capital can just be redistributed.
Yeah, that's exactly what he is proposing, at least. That's what I expect to see. But that would be a double-digit dividend yield on normalized earnings. So you don't need heroic assumptions to sort of see that the company is undervalued. I think that they can do $7 to $8 million of net profit after tax in the 2024 year. So free of the normalizations and including some run rate from the acquisitions. I think they can do 7 to 8 million. And then they have 40 million in cash, but also they already had 5 on their balance sheet. So the market cap being 73 million, take out 45 million. You got an enterprise value of like 28 million. So $7 to $8 million of earnings, enterprise value of 28.
Yeah.
Don't need any assumptions to make that sound good.
It's quite appealing.
Yeah.
And with when you were talking about they're trying to grow margins, is that going to be by trying to invest in the higher margin divisions? Is that the idea then? Growing them over the lower margins?
So, yeah. I think that is definitely part of it. But there's some work to be done in the higher margin businesses, especially the media business they acquired last year. So that business, well, actually, let's take a step back here. They're divesting Morrison's, which is the lowest margin part of the business, and yeah, so that pretty much already brings margins up a lot. But there's some work to be done on the media business. So the media business on like a normal year-to-year basis should be very high margin. Like I think it's part of the professional services division, and the professional services division, it's close to 40% EBITDA margins. So the group itself, like I said, 130 million on $9 million of EBITDA. I think once you take out Morrison's, it's more like 100 million of revenue and probably about 7.5 of EBITDA. So sort of 7% margin. So if the media business can grow, then definitely very, very impactful to margins. And then, I think they want to make some insurance broker acquisitions, and they just made one in the legal document space, and that business has always had high margins. So there's some acquisitions here that'll grow the margins, but there's also some post-integration work they need to do. Yeah.
Okay. And what do you see then as the major risks here? I mean, is there anything that could happen in the next year or two, or that would sort of break your investment thesis and make you consider selling?
For me, the primary, like I spoke about the M&A being fairly modest, like returns wise, what did I say, 11% returns on capital.
Mm.
And if you look at the media business, that's probably negative. So if they misappropriate capital, then that's really the main risk for me. But there's also if the remediation, the $2 million remediation, if that recurs, I should say, that's, I think it's outside of our control. But if it recurs, then that's not great. But I don't expect it to, because I think advisor education standards are going to stop that sort of thing happening more often. Yeah, and then the advisor market itself, it's like I said at the start of the call, it's been in free fall for the last 5 years. So, who knows where it ends up? But 15,000 advisors now. Sequoia has about 310 of those. So it's like a 3% market share. And they want to grow market share in all of their divisions. So there's presumably some volume growth. But yeah, demand for advice remains strong. So one I like to reference in particular is self-managed super funds are like a really big part of financial advice. And the net assets per advisor in the past 4 years have doubled. So, advisors have more and more money to advise on, but there's less and less advisors. So I think the supply demand dynamics are really, really tightening up. That pushes advice fees up. So,
and with the legal
presumably,
stuff you're mentioning as well, you said you mentioned there was potential for them to claim some of that back on insured. Is there a professional indemnity insurer they use to protect against some of these things?
yeah, exactly. That one it's anyone's guess whether they get that money or not. But yeah,
But it will help to
really.
protect going forward if these kind of things do happen again. You've got some short-term hit.
Yeah, that's right. You got a precedent, effectively. So I'm sure this has happened with other firms. So you can always point to a specific case law. That might be a good exercise to sort of try and find like similar cases in the past. Yeah, but that's definitely that's a possibility that more people come forth and try to recover monies on bad advice.
All right. So, I mean, do you think we've covered things well there? Is there anything else you wanted to mention about the company, your investment thesis? Have you?
No, I think we covered it pretty well. But there's you can find a couple posts. There's one deeper dive on my Substack, which kind of goes through every single subsidiary. So I kind of just went through their financial report where they list all of their subsidiaries, and I just went one by one through every entity. So you can find that on my Substack. There's also there's a discussion I did with a person on Twitter named, his pseudonym goes by the name Buyback Capital. You could probably, if you just YouTube search Buyback Capital, Tristan Wayne, you'll find that interview. And I spoke at length about Kelly Partners and Australian family lawyers, but there is a bit at the end about Sequoia, and that was closer to the announcement of divestment. So some things have changed, but yeah, that's out there as well. There's on the document that's pinned to my Twitter profile, you can see some commentary in those letters and a one-page pitch at the end as well. So
do you want to mention what your
yeah.
Twitter handle is and any other kind of, your Substack address and what have you?
So Twitter handle is hurdle_rate, so HURDLE_RATE. Yeah, I'm tweeting pretty often out there. You can reach out to me on that, either through like a comment or a direct message. You can also email me. You'll find my email in the document that's linked. You can also, if you would like to, you can subscribe to my Substack. It's called Hurdle Rate as well. Not actively posting at the moment, because it used to be a paid Substack, but once I started the fund, I moved it back to free, and I'm not actively posting at the moment. But yeah, there's a whole entire backlog of 4 years or so.
Yeah, you've got a lot on there.
Yeah, so if you want to go back and see any other ideas that I've written about. Yeah,
and then of course, your fund letters as well have got ongoing updates on these companies and stuff like that as well, haven't they?
Yeah, that's right. There's a live link on my Twitter profile that's like pinned to the top of my Twitter profile. And that link I will update. Hopefully the link doesn't break, but I update it every month. So I just replace the PDF with a new version. And yeah, I'll post about that. Yeah.
All right. Well, thanks a lot for coming on, Tristan. Yeah.
Thank you very much. Thanks for having me.
Yeah, it's been a good, interesting conversation. And thanks to everyone for listening. We'll catch you all on the next one.